said, welcome everybody to Marketing Matters. I'm Sarah Touchstone with Landmark Title. This is our weekly webinar series that we bring to you every Wednesday at 10 a.m. And we bring you the best in the business when it comes to their real estate advice, marketing advice, and today we're going to be talking about advice for working with investors. I've got Roman Saldutti with US Bank joining me today. Roman is one of my amazing BNI partners. If you don't know what BNI is, it's Business International Networking. That's right. We're networking people. So I was so excited to bring Roman on today because he works on the commercial banking side of things. And I know that a lot of the people that are on our webinar, you guys are residential real estate agents, but we're always looking to expand our business and what we can offer our clients, whether that's moving into the commercial space, whether that's multifamily residential things, or even helping out with 1031 exchanges. So this is it's a newer realm for me. So I've been picking Roman's brain about this. And when he was able to come on to a Marketing Matters, I jumped all over it. So I'm going to hand it off to Roman today and we're going to get started. What are you talking about, Roman?
Sweet. Yes. All right. So today we're talking about investing in commercial real estate. And just to kind of go along with what Sarah was saying, this presentation is something that I usually give in person. I think it's my first time doing it in webinar format, but in person for a group of investors who typically are new to commercial real estate investing, and most of them will have owned single family residences, so residential homes, second homes, things like that. So that's who the typical audience is. So I will be doing a lot of teaching and explaining and things like that. So if you are a residential real estate agent, hopefully this just broadens your knowledge. Obviously, you've probably dabbled or learned about commercial real estate, but this will be from the bank's perspective and towards an investor. But hopefully there's some value. So today, what we will cover is the advantages of what we call income real estate over all the different types of investment vehicles. If you're a residential real estate agent, you already probably see the benefit. The advantages of multifamily over residential, not trying to ruffle any feathers here, but there are some pros and cons, and we'll go over that. The basics of how we analyze a property. This is a hot topic for people. And lastly, how to understand and qualify for the financing for it. So you don't have to pay cash for all of it. Oh, and one more bullet point, understand the expectations for that purchase and renewal process. So let's jump into it. But first, who am I? And usually I've got one of my partners on here, but today I'm flying solo. So I am obviously Roman. Sarah introduced me. I work on the business banking and commercial real estate side, specifically for US Bank is who my employer is. But I'll try to be as, we'll say, non-denominational and speak in broad general terms, although some things will apply to how US Bank looks at things, and it will be a little bit different depending on what lender. So a little bit of fun facts real quick, and why you should listen to me. You don't have to, you could turn this off if you wanted to, but I've been in financial service for over 10 years. Previously, I was a mortgage loan originator, so that's kind of where my residential knowledge comes from. And then at US Bank, I have been a personal banker, and then for the last 5 years, a business banker. And before all of that, I was working in sales and marketing, did a lot of digital stuff, social media marketing. So I think that's why Sarah and I are BFFs, because kind of play in the same space there with all the marketing stuff. And I think I've got one more fun fact, maybe if you, yes, okay. So if you couldn't tell, and usually I'm in a boardroom and you wouldn't know this, but if you look behind me, you can tell that I have played music in different bands at different skill levels, but some professional bands for over 15 years. And then my better half, my wife, is from Sweden. And so at home, we speak Swedish with our 2 boys and soon to be a girl. So that's a little bit about myself. Well, let's jump into the content. So let's go over some of the basics. Let's see, we'll go over the terms and acronyms, and if you know, with residential, there's all sorts of jargon that you get used to. Commercial has got its own language, and it can be very confusing because most people don't dumb it down for you. They just expect you to know it. And then what are the different types of commercial real estate properties? Some brokers will only focus on one specific type. So it's very important that you know what those are. And then, oh yeah, those are the two things. So yeah, I'm used to doing this live. Okay, so I'm going to confuse you for a second, Sarah. This should be the spot where we just kind of rapid fire them. So you've seen some of these terms. I'm going to start saying it. 1031, DNI, CRE. We call it leverage or downstroke. Oh, this is a value add play. What's the cap rate on this property? What's the NOI on it? Is there any CapEx involved on this project? And then I fill in some of them there of kind of what the acronym is, but kind of what it means. And then if you kind of click next again, I think it just really fills it in with even more stuff from triple net. The DSCR is a banking term. Yeah, just all sorts of stuff. And I'm not going to like go over every single one of them. Is that all of the ones I put in there? It's probably a lot more. So, okay, let's jump into one of the terms. This, I think, is more of a banking term. I think if you said this to a commercial real estate broker, they might not necessarily be familiar with this acronym. But in the lending side, DNI is what I would call an investment property. So the inverse would be, or the opposite would be owner occupied. That would be for a business buying their own commercial building. DNI would be what we're talking about. So we've got office, we've got industrial, we've got retail, and we've got multifamily. And then if you click next, I should have a graphic. So today we're going to mostly focus on multifamily. Ooh, coming right at you. And then I did say there's 6. So if you click next, there's 2 other sectors, special purpose, which would be, I think of it as like a church, and there's other things, and then hospitality or hotels. Those are definitely popular, but US Bank in particular, we're not super hot on it. And so it's not really where my knowledge base or skill set is. So they exist, but I'm not going to really probably talk about them too much. So let's get into why you're here. If you're an investor, I don't know if this will apply to everyone else on this, but what are the advantages of real estate over other investment vehicles? And Sarah, I might kind of gloss over this a little bit more. Again, this room would be filled with people who have their 401ks and mutual funds and maybe their Robinhood accounts or whatever people are trading on these days. And so it's kind of like, why should I take the money out of those investments and put it into real estate? I think for all of the real estate agents here, I might not have to go over that as much because we're all biased.
You know why.
We're all biased here
We're
towards
hip.
real estate.
Hip
So
to the game.
yeah, so I think I listed out though. I mean, just you have an appreciating asset. It's diverse. You actually get cash flow from it. I mean, volatility is insane right now with the stock market or a crypto or anything like that, even the 401ks, where and especially commercial real estate is less volatile even than residential. It's some people like having a hard asset or a real physical thing that you go see, you can touch, feel, you can smell sometimes, depending on how classy that apartment complex is. And then is that all the bullet points I put for there? So yeah, and with the inflation, right? So it's an asset that's appreciating, and then definitely tax benefits. And I can't go over those too much because I'm not a CPA, but you all know what they are. If you don't look it up, ask a CPA. So now we've addressed why real estate, and again, everyone here I think should feel as I do that it's a great investment. So why multifamily over residential? And it's not necessarily one is better than the other. I honestly think most people should start with residential, and then eventually I think your average investor just wants to kind of crank it up. So let's talk about kind of just what some of those advantages are. So let's get the bullet points. So, and you can flesh them all out, Sarah. So for the income potential, yeah, we'll go back one. So you could potentially make more money because you can get a larger project that's producing all sorts of income. You can scale faster. If you have to fix something like a roof or something like that, you fix it for one multifamily project at one time versus if you owned a portfolio of single family residences, it's a little trickier to do that. Once you get to multifamily, property management starts making a whole lot more sense. Not that it doesn't at the residential level, but it really, really makes sense. So it becomes more of a passive income. And then the multiple tenants aspect. So if you have, one single family residence and you lose your tenant, then your income goes to zero. Where with multifamily, people are kind of coming and going, but you're not losing all of your income. So those are just kind of the main things that people like from multifamily over residential. But again, one's not necessarily better than the other. They're just a little bit different on the pros and cons. So question number 3. This, I think, is going to be the meat and potatoes, and this is where I might bore some people or lose some people, but feel free to throw stuff in the chat on this. And your eyes are functioning. I just have it blurred out so it doesn't, so you don't get too focused in the weeds. But how do I analyze a property? It's just such a huge question, and I would say the biggest question that I'm trying to get answered when I'm analyzing a property with a client is how much money do I need to put down? And so some people may scratch their heads and say, oh, well, if the thing's selling for $1 million, what's your maximum loan to value? Can't you do 80% or 70%? And so the answer is, for a cash flow based lender, which is what I work for, the loan amount is completely dependent on the cash flow of each individual property. So I can tell you that I was working with a client who had a specific target. He had a 1031 exchange, so he had a certain amount of money that he needed to deploy in his next investment. And so we looked at 30 properties that the sale price was $1 million. And because the cash flow is different on every one of them, the maximum loan to value or loan amount I could do for the property was completely different. So I'm going to show you why that is and how we look at it. So this is the fun part. So first, you want to get an offering memorandum, and this should be similar on the residential side, but this is the listing agent or the seller puts together these brochures, and I always tell people that they're not always worth the paper they're written on, because the purpose of this brochure is to sell the property. So they're going to make it look as good as possible. And my job as a lender is kind of be on the other side and find the weaknesses and poke holes in it. And the real answer might be somewhere in between. So let's dive in. And there's nice, colorful pictures and all that stuff. But what I'm really looking at is something like this, the rent roll. Okay. So this is super generic, and I'm on my phone, so I can't really see the numbers too well. But what you're looking for is the current rents, that's the actuals. And they're always going to put a best case scenario pro forma, which is fine. We'll actually use both. So this is a 6-unit multifamily property. We've got all the income, which is the rent. And so we'll take that number and we'll make an annual number out of it. So it's at the bottom. So we got 78,000. It looks so tiny on my screen, but that's our annual income. So next we're going to try to find the expenses. Okay. So this one is where it gets a little bit tricky in terms of breaking it down, because the offering memorandum is going to be somewhat vague. But what I'm really looking for is recurring expenses, not capital expenditures or CapEx or one-time expenses, but what is the owner of this building going to be responsible for month after month. So there's some expenses that I just take right off this brochure, and there's some that I add as what we call sensitization. And some of those, and I might have a slide for this, but I'm just going to get ahead of myself. Some of those could be a vacancy factor. So even though the property could be fully occupied, we're going to just sensitize the property with a vacancy factor. That probably isn't completely foreign to most people, but as a buyer, they might say, well, this thing's fully occupied. And we just say, you know what, we're going to factor in just in case it does become vacant for any period of time. We're going to buffer for that. So right now in Arizona, we're seeing a vacancy factor between 5 and 10%. So we're going to take that out of the total income. Another sensitization would be reserves, and then management fee. So anyway, I'm going to pull these expenses out. And if you go to the next slide, it should show the formula. So basically, we need to get the net operating income. And I think I break this down even further, where it's just the total income, and you take out all of the other expenses. And it ends up being about 16% is the sensitization. So that's a combination of vacancy factor, management fees, and reserve, and then other expenses such as insurance, taxes, and things like that. Okay, so you take the NOI and then you divide it by what's called the debt service. So I don't know if everyone here really likes math. I'm not really a math geek, so I've got a sheet that does this all for me. But basically, the debt service is you take the loan amount on the property and you take those monthly payments and you make an annual amount for that. So you divide the net operating income by the debt service, and now we have what's called a cash flow ratio or debt service coverage ratio. Okay, so it's all kind of mumbo jumbo, but this is the behind the scenes work that's going on. And I think if you go to the next page, I have an example of what it looks like. Click through a little bit because I've got the income on top, I've got the expenses on bottom. Yeah, exactly, it's perfect. So I feel like I'm pointing at my screen as if you guys can really see what I'm pointing at, as if I had the projector on the background, which I normally do. But if you look at the sales price, what I usually do is type in the actuals and the pro formas, and sometimes they're hugely different. But I put them both in just to get both numbers. So we take the sales price. I will take the income, so that's the rents, type that in. I put in the sensitization, so you see vacancy reserves and management, and then I put in the taxes, insurance, and all the other expenses. So now we've got all the expenses, you got the NOI, and then normally you have to kind of back into the numbers, but I created an Excel spreadsheet that really just does this all for you, but it determines the maximum loan amount to get that debt service amount that's going to get you at a 1.25. So again, this is really the meat and potatoes and part of probably why I have a job. I'm happy to teach this stuff just so people get the gist of why it's not, oh, why can't you do 80% loan to value? This is really what's happening kind of behind the scenes on a property, and why I could look at $30 million properties and they all cash flow differently. So if someone has questions on this or you want me to go slower or whatever, I'm happy to. And this one, look, if you look at really cash flows super poorly because the max LTV is only 30%. I mean, that's really bad. Right now I'm seeing, this is a big question, like, well, what are you seeing? Probably between as bad or as low as 40% up to 60%. If it's a pretty savvy investor, I can actually sell pro forma numbers to our underwriters and say, hey, they know what they're doing. They're going to come in, they're going to bump rents up, they're going to reduce expenses, and these are the numbers they're going to get. And I can get away with that with underwriting. So that's why I include both of them. So yeah, maybe I lost people, but at least you kind of see the why behind the loan to value calculations. And this is just, again, that critical factor when I'm working with an investor. They want to know, I've got 300 grand in my hand, how much can I buy? And this is really what answers that question, and kind of why it's not so simple of, hey, you got 300 grand, we can do 80% loan to value, here it is. No, it's like, let's go look at properties and start cash flowing them. So again, I've got a formula that makes this happen really, really quickly, but now you know how the sausage is made. So
I think this is really great though, Roman.
Oh,
like
thank you.
I said, I've got some residential agents that have dabbled a little bit into multifamily. So I'm very familiar with a lot of this, but I'm eating it up. Like, this is
thanks for the feedback. I'm like, I geek out on this all day long, but I know this might not be everyone's cup of tea. So if you didn't learn a single thing from this, like calculation, or you didn't memorize how it's done, again, I've got a formula that does this for me. And so the point is to know that loan to value isn't such a simple question to answer, and it's based on this formula. So let's jump into, I think we're gonna, I don't know what, oh, here we go. So I think I mentioned this at the beginning, but don't take a brochure and offering memorandum at face value. There's a lot of questions that need to be asked about these properties. Again, they're trying to make it look as good as possible so that you can sell the building. I don't know if I have any other pop-ups. Nope, okay. So here is kind of like that next big question. It's like, okay, now we've determined that, you know, this property I'm interested in, it's selling for $1 million, we cash flowed it. The maximum loan you can provide is, we'll say, $500,000. I've got the other $500,000 in 1031 funds or cash or whatever it may be. Okay, now how do I qualify for it? What do the terms look like? Can I expect a 30-year fixed, you know, mortgage like I can on a house? So let's jump into that real quick. Obviously, every bank is different. So what we're really looking for on the qualification side is, just like we mentioned, the cash flow needs to be there to support whatever your down payment is. So if the cash flow is really bad, like, we could still do the property, we just need more money from you. So it's not, the amount of money you have to put down is really the qualifying factor. The building cash flowing just determines if it fits your budget. Next would be a good global cash flow coverage ratio. I'm not going to like go into that so much, but we'll just say it's the equivalent of a debt to income ratio. It's just calculated a little bit differently and expressed as a fraction and not as a percentage. So that's how much debt do you have? How much income do you make? Can you make the payments on this property or on this loan for the property? Overall clean personal credit. This kind of goes without saying, and it's somewhat vague, but if I'm talking to my investors in my typical seminars, I point out that the company I work for doesn't really do well with severe derogatory credit like bankruptcies and foreclosures and things like that, but there are plenty of lenders that don't mind so much. But if you just have clean credit, you're fine. There's not really even like a FICO score I'm looking for. It's just be clean, I guess that's the way I'd put it. And I think most people are expecting that. Let's see. So for the purchase process, this is kind of the big question as well from these investors. Like, great, I feel like I understand what's going on, but I want to move forward. So what does that look like? So this is where you guys potentially come in hand for the realtors on this webinar. Is my first thing is I always direct them to get with, we call them brokers on the commercial side. It's basically a commercial real estate agent. We just call them commercial brokers. That's my first step. Go find someone that you can work with, because a lot of investors try to get me to do a lot of the realtor work, and I don't get paid the way real estate agents do to show these properties. So even though I have a CoStar license, I'm like, go talk to a professional broker first, okay? And every one of them specializes in different things and has a different zip code they want to cover. So find someone that you want to work with, and then do one more bullet point for me, Sarah. Let me see. I forget what I wrote here. Okay. So I would say do that first, and then simultaneously, I could start working with the clients. So this is a huge question that I get is, can I get pre-qualified? And there is not necessarily an official letter I give people that's like, hey, you're pre-qualified up to $1 million. Have fun shopping, the way you can kind of get on the consumer side. But I can basically get with a client and get things in order. That way, once we find the property, we already know that the person themselves are financeable, is what we say. And I can issue a letter of intent, but again, it's not a pre-qual letter. Let's see, my little window's in the way. Let me move that. And then I am always happy to help the borrower analyze properties and find one that works. It's kind of just a free service that I provide. This is the renewal process. This has more to do with the investors, so I might gloss over this one. But basically, well, let me talk about terms real quick. So I don't know if I have a slide for this or a bullet point, but I asked a question, I didn't answer it. So typically what borrowers can expect from commercial financing, there's no 30-year fixed loans are just not very common at all in this space. And going from mortgages to this is kind of an eye-opener. So really typical is a 5-year term on a 25-year amortization. So yes, that does mean every 5 years, the borrower would have to either have a balloon payment or renew with the bank, or you could refinance elsewhere with another bank and maybe get a better deal or sell the property. So that's really what you're looking at as a 5-year term, but you're making payments as if it's a 25-year loan. That's the amortization. So I'll just throw that out there because again, it's a big question that people have. So there's the fun banking stuff and kind of what wraps up everything that I have to talk about. Hopefully I'm in good time, Sarah. I know I've got half hour. Yes. So again, I geek out over this stuff. It's fun for me, but yeah, hopefully there was some value here and you just have a little bit better understanding of what commercial real estate looks like from both the investor and banking side. So yeah, do we get any questions or anyone have any comments?
Does anyone have any questions? I think people's minds were probably super blown by all that information, Roman. That was really awesome though. And I really, I know, like I said, I know that a lot of the agents that get on Marketing Matters are mostly residential. However, a lot, and you and I talked about this, a lot of brokerages allow their agents to do multifamily, to do commercial. And I get questions all the time from agents about moving or expanding their realm. And as we get all of these out-of-state investors coming into Arizona, I really think we're going to see a huge boom over the next couple of years with investors, with the 1031 exchanges. We've done several classes based on 1031 exchanges. And that's something that if you want to do, you got to be up to date on how to do these things. I think, like I said, we're going to see a lot of multifamily investors coming in and wanting to do this. And they're going to be reaching out to residential real estate agents. You know, commercial, that's a very specific realm. However, here at Landmark Title, we've got all of the tools to help you along the way if you're looking to expand your business. We actually do commercial and multifamily escrow. So that's where we actually started. We started with a commercial escrow, and then we expanded into residential. So commercial is absolutely within Landmark Title's wheelhouse to offer to you and your clients when it comes to title and escrow. We actually do have a question, Roman.
Yep.
Are you saying yep as in you see it?
I see the question. I guess the answer is also yep. But yeah, so no, I absolutely work with the clients and run the numbers and analyze as part of that process. I want to help find the property just as much as the broker and the client do. Obviously, I get paid once the deal happens. So yeah, I'm very involved in the process as much as possible to help them out.
Awesome. Well, if anybody else has any questions, please let us know. Like I said, we've got the tools here at Landmark Title to help you if this is a realm that you are interested in diving into. So please, we're going to be on for a few more minutes. If you guys have any questions for Roman.
We want to talk about pricing.
Yes.
Yeah, I didn't really mention pricing too much. So
average
again, it's old.
Rate.
Yeah, sure. I'll be happy to touch on that. And I could pull it up, I guess, while we're doing that. Basically, the way it works for us and most commercial lenders is it happens a little bit more in real time than on the mortgage side. They usually get their rates that last, I think, a little bit longer. So for us, I will log in right now to our treasury and check out the cost of funds. Okay, so I can't see what I'm looking at, but I'm looking at our cost of funds for kind of a variation of different terms. And then I have to spread, so the cost of funds is what it's costing us, right, to lend the money. So then I have to spread the final rate a little bit higher than the cost of funds. And I actually have authority over what that ends up being. They made a change almost 2 years ago. I used to get paid on that spread and they got rid of that. So I'm no longer motivated to charge a higher spread. So to kind of answer the question, I work with each client and find a rate that kind of works best for them. But the cost of funds is changing every day, up or down, up or down. Once we get that final approval and go to lock, then we've got that final rate. So like just to give you a ballpark, on a 525 today with a standard spread, like an off-the-shelf spread that would be recommended, today it's 3.23, but without too much fuss, I could personally authorize like 2.98 today. And I could go lower, yeah, which is really good. And I could go lower if it's the right situation, but then I have to go through kind of layers of approval, which I'm happy to get, and usually can get it. But that, and I say today, because tomorrow it's going to be a couple basis points higher or lower. Unfortunately for us, they shot up by about 20 basis points in the last week or so based on the current kind of economic environment. But we've had plenty of situations where I quoted a certain rate. By the time we went to lock, it was much, much lower. And I reflect that in the final rate. But yeah, right now we're expecting high 2s, low 3s for this type of product.
Nice.
Hopefully that answers the question on kind of what it is, but also how we arrive at that number.
Excellent. Excellent. Well, like I said, if you guys have any more questions, I'm going to run through some of the other classes that we have coming up. On July 8th, we have our Market Insights class. This is our monthly market stats, but it's not just market stats, it's dives deep into what's going on. And we usually have this on the first Thursday of the month. So quick reminder, the first Thursday, which is tomorrow, is the first. Stats don't come out until the second. So we're bumped back. So this is not tomorrow. It is next week, the following week. That's at 9:30 a.m. You will definitely want to get on there. Last month was incredible. We really dug down into the different cities and what's going on and which cities are growing and how you can take this information back to your clients and be the person in the know. So that is July 8th. And then towards the end of next month, we have I think it is our 4th mastermind with Realtor Mind Tricks. This is all about creating a referral-based business based on your sphere of influence and basically training your sphere to give you those really strong referrals. If you haven't attended any of the masterminds yet, just reach out to Patty or Michael. We've got the video recording of the class. We can get you up to snuff with what we're doing. This one is in person, or you can hop on Zoom. It's a hybrid class. So if you're interested in that, I think some of our other BDMs are going to be offering this come fall as well. So if you're even interested in this topic, if you really want to expand your business in the fall, reach out to your BDMs, tell them, I want Sarah to come teach Realtor Mind Tricks. This is a super fun class, followed by a 6-month mastermind. It's incredible, guys. And it's not just incredible because it's my class, it's incredible because it's incredible. And then in August, we have a Solar CE class with the Tara. If you've never taken one of Tara's Solar CE classes, get on to her Solar CE. This is a great class. Sometimes there are people that even get on her classes just to get the information, not even for the CE credit, because they are that good. This is going to be an in-person CE class. I know some people prefer that. They learn a little bit more. So if you would like to register for this one's not till August, but it's going to fill up because it's in person. So reach out to Patty, get registered for this class, and start getting that CE credit. You know, registration and renewal processes sneak up before you know it. So make sure you are up to stuff on all your CE classes. And then Beth has a FERPTA class coming up in August as well. She just booked this, so we don't even have a marketing for it yet. But I want you guys to go ahead, pencil in your calendar. This one's going to be a Zoom class, August 17th at 1 p.m. So that's about it for us on Marketing Matters today. Thank you again to Roman. That was great information. Roman has some other webinars coming up too. So if you want to be invited to those, if you want to dive a little bit deeper into the world of investment real estate, please reach out to us. We'd be happy to get you registered, let you know when those classes are, and get a little bit more information. You know, Marketing Matters is just such a quick overview a lot of times, but there is so much more information out there, and we'd be happy to get it to you. And as always, thank you to our business development management team, Beth, Becky, Melinda, Mary, Eric out of our Las Vegas office, Zach, Patty, Michael, and Jessica. Y'all are awesome. So glad to have you on our team here at Landmark Title. And as always, thank you to Landmark Title for allowing us to bring you amazing content like this, not just marketing content, but really educational content. Great information that you can take back to work with your clients and be the agent in the know. And please think of Landmark Title on your next contract. We have 6 offices to service you across the valley, and we do commercial. So if this is a realm that you are interested in, please think of us. We'd love to help you along the way. And once again, thank you to Roman. This was great information.
Thank you, guys. Thanks, Sarah.